When it comes to the intricate dance of global oil markets, few factors are as electrifying or as polarizing as geopolitical tensions. And right now, the world is watching as those tensions take center stage once again, breathing new life into oil prices. If you've been following energy markets this week, you may have noticed something remarkable. Crude oil futures rallied significantly, with light crude closing Thursday at $63.52, a jump of $1.54, or plus 2.48% compared to last Friday's close. But here's where it gets interesting. This surge wasn't just about supply and demand fundamentals. It was driven by a potent mix of renewed optimism for global energy consumption, bullish inventory data, and most critically, the resurgence of geopolitical risk. Let's rewind a bit. At the start of the week, traders were cautiously optimistic. Why? Because there was hope, genuine, palpable hope, that peace talks involving key players like former US President Donald Trump, Ukrainian President Volodymyr Zelensky, and even the possibility of Russian participation in a trilateral summit might ease the strain on global oil supplies. The prospect of sanctions relief on Russian crude had market participants pricing in the potential for a more stable energy landscape. But then, reality struck, and hard. Midweek, the fragile threads of diplomacy began to unravel. Russia and Ukraine traded accusations, each blaming the other for derailing negotiations. To make matters worse, Russia launched a significant air assault near the EU border, while Ukraine retaliated with a targeted strike on a Russian refinery. With no ceasefire agreement in sight, the situation escalated quickly, rekindling fears of supply disruptions and sending shockwaves through the market. Analysts from Reshape and Associates pointed out that a geopolitical risk premium is gradually creeping back into the equation, while others raised alarms about mounting speculation regarding stricter sanctions against Russia. This sudden shift in tone, from cautious optimism to heightened uncertainty, was enough to jolt market sentiment and provide a much-needed boost to oil prices. It also served as a stark reminder of just how vulnerable global energy markets are to political instability. After 2 weeks of downward pressure on prices due to selling activity, this resurgence of bullish interest underscores the delicate balancing act between supply-side risks and market psychology. And this is the part most people miss. Geopolitical risks don't just affect physical supply chains. They ripple through investor confidence, trading strategies, and long-term forecasts. For instance, if tensions continue to escalate, could we see another wave of speculative buying? Or will cooler heads prevail, paving the way for a more stable pricing environment? These are the kinds of questions that keep analysts up at night and fuel heated debates among industry insiders. So what do you think? Is this latest rally sustainable, or is it merely a temporary blip fueled by emotion rather than fundamentals? Do you believe diplomatic efforts will regain traction, or are we headed for even greater volatility? Share your thoughts in the comments below. We'd love to hear your perspective. By the way, if staying ahead of these kinds of developments sounds important to you, and let's face it, in today's fast-moving world, it absolutely should, consider joining our Global Energy Alert membership. You'll gain access to breaking energy stories before they hit mainstream media, expert analysis from seasoned industry professionals, exclusive investment opportunities, digestible data breakdowns, and geopolitical insights from our vast network of over 600 operatives, all for just $279 per year, originally $697. Plus, we offer a risk-free 30-day money-back guarantee, so you can try it without any worries. Don't miss out on the information edge that could make all the difference.